Let's use the contribution margin ratio to compute changes in our contribution margin and net operating income resulting from changes in our sales volume. Our contribution margin ratio is calculated by simply dividing our total contribution margin, which in this case was $100,000, by our total sales of $250,000. We have a contribution margin ratio of 40%. Another way we can arrive at this number is to prepare a partial common size income statement. Recall, for a common size income statement, we take every item on our income statement and divide it by sales. So $250,000 in sales divided by 250,000 gives us our 100%. Our variable expenses as a percentage of sales are 60%, which is our $150,000 in total variable expenses divided by our $250,000 in sales. If we subtract our 60% expense ratio from our 100%, we're left with our contribution margin or profit of 40%. So to interpret this, we can say that for every $1 in sales, it's costing us 60 cents, and we're making a profit or a contribution margin of 40%. We can also calculate our contribution margin ratio by using per unit amounts. Our variable cost per unit was $200. If we divide that by our selling price per unit of $500, we get the same 40% contribution margin ratio. If the racing bike company increases sales by $50,000, its contribution margin will increase by $20,000. We can calculate this by taking the $50,000 in sales and multiplying it by 40%. Because again, for every dollar in sales, we get to keep 40 cents or 40%. We can verify this by comparing our break-even contribution margin income statement for 400,000 units with a 500,000 bicycles or 500 units sold for $250,000 in sales. So notice a $50,000 increase in sales resulted in a $20,000 increase in net operating income. A useful feature of our contribution margin ratio is we can calculate this change without having to prepare a completely new contribution margin income statement. Let's take a look at an example. Last month, when Holiday Creations Inc. sold 50,000 units, total sales were $200,000. Variable expenses were $120,000, and fixed expenses were $65,000. What is the company's contribution margin ratio? And let's estimate the change in the company's net operating income if it were to increase its total sales by $1,000. Let's begin by finishing off our contribution margin format income statement. Our contribution margin is our sales minus our variable cost, which will be $80,000. Once we subtract our fixed cost of $65,000, we're left with a total net operating income of $15,000. Let's now calculate our sales and variable cost and contribution margin as a percentage of sales. Sales is always 100%. We just simply take sales and divide it by sales. Our variable expenses as a percentage of sales are 60%. That's the $120,000 in variable cost divided by $200,000 in sales. This means our contribution margin ratio will be 40%. We can calculate this by taking the $80,000 contribution margin and dividing it by sales, or simply subtracting our variable expenses of 60% from sales. Let's go ahead now and use our contribution margin ratio, which is 40%, to calculate the change in our net operating income when sales change by $1,000. We'll simply take our change in sales and multiply it by our 40% contribution margin ratio to arrive at our total change in net operating income of $400. We can verify this by preparing a new contribution margin income statement. Our sales were going to increase by $1,000, so sales increased to $201,000. Our variable expenses will be $120,600, which is our sales of $201,000 times our expense ratio of 60%. This means our contribution margin will increase to $80,400. Since our fixed expense remained constant at $65,000, our our net operating income will increase by $400 to $15,400. This is the same answer we got by multiplying our contribution margin ratio of 40% times the change in sales.